$3 million. That is the line where the new Division 296 super tax starts. If that headline made you look at your own balance and wonder whether a healthy six-figure account is suddenly a problem, stay with us. By the end, you will know the threshold, the earnings slice, and the one check worth doing tonight. We checked the ATO's new Division 296 guidance and put it beside the balance numbers ordinary families actually see, because the headline alone is not a calculation. The short version is reassuring for most people. This is aimed at very large balances, not at a normal account that has simply grown over decades. Quick note before we unpack it. This is general information, not personal tax or financial advice. Superstructures, pension status, contributions, and investment decisions are personal, so use this as a map for better questions, then get advice for your own situation. The first test is simple. For the 2026-27 income year, the large super balance threshold is $3 million. Your total super balance is the combined value across your relevant interests, not just the account you happen to open most often. Under that line at year-end, this particular Division 296 tax does not apply. That combined balance point matters. People can have an old retail fund, an industry fund, and perhaps a self-managed structure. Then look at only one statement. The useful question is not whether one account looks large. It is whether the total balance used for the tax test crosses the legislated line. Now for the reframe. Division 296 is not a flat new tax on your entire nest egg. It is an extra personal tax connected to taxable super earnings and to the proportion of your balance above the threshold. That distinction is the difference between a frightening headline and a useful calculation. Think of the process in 3 steps. First, the ATO looks at the relevant total super balance position. Next, it works out taxable super earnings under the legislation. Then it attributes a proportion of those earnings to the part above the threshold. The 15% Division 296 rate applies to that attributable amount, not automatically to every dollar you own. The word proportion is doing real work here. Someone only a little above $3 million does not have the whole balance treated as if it sits above the line. The calculation is designed to isolate the excess share, which is why balance, earnings, and timing all matter together. The legislated package is also commonly explained as focusing on realized earnings rather than simply taxing every paper movement in an asset you still hold. That is an important change from the earlier public debate. Still, the exact treatment can depend on the statutory calculation, so a fund statement is not a substitute for an assessment. This is why you may hear people describe effective rates near 30% on an affected slice. They are combining familiar fund tax context with an additional individual layer. That shorthand can be useful, but it becomes misleading when it implies every dollar below $3 million is suddenly taxed at a new rate. It is not. The fund reports relevant information, but the Division 296 liability is an individual assessment. That matters for couples too. A household can feel like one financial unit, yet the threshold test and assessment operate at the individual level. Do not divide a combined family number in half and assume that tells you the answer. The best antidote to panic is scale. Contextual benchmarks around ages 60 to 64 sit in the hundreds of thousands, roughly 245,000 for a medianish balance, about 339,000 for women, and about 452,000 for men in the figures used in our research. The Division 296 gate is 3 million. Those benchmarks are not targets and they are not eligibility tests. They simply show the distance. A person can be diligent, have meaningful retirement savings, and still be nowhere near this measure. That is the practical relief many headlines skip. A solid balance is not the same thing as a very large balance for this law. Even the retirement comfort conversation sits on another scale. A single-person comfort benchmark around $595,000 or a stronger $700,000 path can be life-changing in retirement planning. But both are still far below 3 million. The policy question and the household retirement question are related only because both use super balances. Industry commentary around the package has described a cohort of roughly 80,000 to 90,000 people, around 1 in 200 people with super. Exact counts change with markets and reporting, but the direction is clear. This is a high balance measure, not a broad charge on the median worker, renter, or family trying to build retirement savings. That 1 in 200 framing is not permission to ignore your super. It is permission to separate two different jobs. Most people should focus on fees, insurance, contributions, investment settings, and duplicates. A much smaller group needs a specialist conversation about Division 296, liquidity, asset mix, and the cost of paying an extra assessment. Separating those jobs protects you from a bad reaction. Do not change an investment plan, trigger a sale, or move money because a headline feels urgent. First, establish whether you are even in scope. If you are not, the better use of your attention may be the ordinary super decisions that compound quietly for years. Here is a deliberately simple illustration, not a personal calculation. Imagine an individual finishes the year with $3,300,000 in total super. The excess balance is $300,000. That tells us they are over the threshold, but it does not by itself tell us the tax bill. The earnings calculation still comes next. This is where online shortcuts often fail. You cannot just multiply the $300,000 excess by 15% and call it the tax. The formula works from taxable super earnings and the attributable proportion. Investment results, contributions, withdrawals, and the legally defined balance movements can all change the result. The useful household lesson is not to memorize a formula in isolation. It is to keep the inputs separate. Balance decides whether the gate is relevant, earnings help determine the tax base, and the proportion identifies the slice linked to the excess. If a quick social post collapses those steps into one number, treat it as a starting point, not advice. There is also a second threshold at $10 million. Above that very large balance threshold, an additional 10% can apply to the attributable earnings component linked to that top slice. Again, it is a layered calculation, not a reason to tell someone with a normal balance that they face a 40% tax on all of their super. Timing matters too. The measure starts from the 2026-27 income year. The first assessments are expected later in 2027-28, after the information needed for the calculation is available. That gap gives affected people time to understand the process, but it is also why confident claims about a precise bill before the assessment deserve caution. When an assessment arrives, people can generally pay it personally or elect to have it paid from their fund or funds. Neither route is automatically best. Paying personally can preserve more inside super. Paying from super can preserve outside cash. The right comparison depends on liquidity, tax circumstances, investment horizon, and advice tailored to the person. Liquidity is the practical reality check for people with large, less liquid super assets. A valuable asset does not automatically create cash to pay an assessment. That is one reason affected members should start early with their fund administrator and an appropriately qualified advisor, rather than waiting for a letter and making a rushed sale. So what should you actually do? Start with the total, not the headline. Log in, gather the balances across your super interests, and check whether you are remotely close to $3 million. If you are comfortably below it, take the relief and return to the ordinary actions that matter more for your retirement. Second, make the records tidy. Old accounts can distort your mental picture, and consolidation can affect insurance, so check before changing anything. The goal is not to rearrange money for a tax rule that may not touch you. The goal is to know what you own, what it costs, and which decisions actually belong on your list. Third, if your total is near or above the threshold, book the right conversation. Bring statements, contribution history, withdrawal details, and any complex asset information. Ask how the statutory calculation applies to your circumstances, what the timing is, and how payment choices affect liquidity. A personalized answer starts with complete records, not a viral estimate. Finally, keep the headline in proportion. The new rule is real and it matters for the people it targets. But it does not turn a typical Australian super balance into a tax emergency. Your practical next move is simple. Check the total, understand the threshold, and only escalate the decision if your own numbers put you near it. That is the calmer way to handle a scary money headline. Verify first, then decide. If this helped you turn the $3 million claim into a useful household check, subscribe. We keep turning the rules around Australian money and life into the next practical step you can actually take.